All right, in this video, we're going to take a look at kind of the current monetary policy that's in place in response to the 2020 pandemic. You can find it at this link here on the PowerPoint, but I'm going to pull it up on a Word document just to highlight a couple points. Okay, this is the press release from the Federal Open Market Committee at the Fed. Just a couple points I wanted to highlight. One, the fact that they're mentioning COVID-19, the COVID-19 pandemic says something. Typically, large events like that are going to be mentioned, or global events, large global events are going to be mentioned in the press release if they're really important and really affecting the economy. In this case, that's what's happening. But a couple of pieces to mention from this statement. One, and kind of the summary, is the overall conditions that the Fed are trying to create are going to be accommodative, meaning they're going to be accommodative for lending. They're going to try to support the economy and specifically the flow of credit, okay? The lending that's going to be available to households and firms. The second, or sorry, in this fourth paragraph, this first line here, this is the dual mandate. The committee seeks to achieve a maximum employment and inflation at the rate of 2% over the long run. That is their dual mandate. They're mentioning the dual mandate and highlighting the importance there. Interestingly, the committee has decided to try to drive up inflation for the sake of trying to lower the unemployment rate. So right now, they're willing to have inflation be a little bit higher than the 2% mandate. And again, they mentioned this for some time, not really specified exactly how long, but for some time, because inflation has been relatively low throughout the year. They're going to keep the target federal funds rate at 0 to 0.25%, so as low as it can go without being negative. To do that, it's going to continue increasing, the Fed is going to continue increasing its holding in Treasury securities and private bank securities or agency securities, specifically these mortgage-backed securities. So we're seeing continued open market operations, as well as quantitative easing by these purchases, by these mortgage-backed security purchases by the Fed. So again, the Fed will then own more mortgage-backed securities and will exchange liquid reserves in exchange for those mortgage-backed securities. So banks will now have more reserves on hand, and this will again support the flow of credit, creating these accommodative financial conditions. Okay, so Fed very accommodative right now because of the COVID-19 pandemic, such to the point that they are willing to sacrifice some inflation, meaning willing to have inflation be a little bit higher than the 2% mandate. Okay? So that's where we're at right now. I hope you enjoyed this video and this week's material.